Hello and welcome to Cafe Mutual YouTube channel. Friends, credit risk funds was among the most popular categories among investors before COVID. But due to several credit events, many distributors and investors shy away from the category. However, if you see the written table, credit risk funds have been topping the performance chart across debt fund categories. So the question is, if the time has come to relook at the credit risk fund, to answer this pertinent question, today we have with us Sushil Budhia, Senior Fund Manager, Fixed Income Nippon India Mutual Fund. Sushil has over 18 years of experience in fixed income market. So without wasting time, let's welcome Sushil. Good evening, Sushil.
Thank you very much. Good evening, Nishant.
Okay. So Sushil, I wanted to understand about credit funds first. So what are the credit risk fund and how do they work?
Hey, hi. Like any other product in the mutual fund, credit risk fund also is one of the fixed income product where idea is to give the steady state accrual return to the investors. Uh, we have to look the credit fund with a moderate risk kind of product and moderate time horizon is required for investor to write the benefit of the credit risk.
And Sushil, what is your near-term outlook on the credit scenario in India?
If you have to divide this question in two parts,
Okay.
because any credit environment is linked to macro environment.
Hmm.
So I will answer the first on the macro environment.
Hmm.
So what we are witnessing, we have improved means the inflation is lower over the last year. The real rate is attractive, so we are in a positive real rate trajectory. The growth and inflation dynamics is looking good. The foreign currency reserves is looking good. The only thing we have to be in a domestic front has to be monitoring is the monsoon and the fuel price, which we do expect a cut in the fuel price, which further moderate the inflation. The global dynamics need to be monitored very carefully because even though after a 500 basis point hike by the Fed, your inflation is not coming down as fast as was anticipated. So we can have the scenario where RBI and the global central bank can remain in a pause for a while for next 9 to 12 months. So that is the macro view.
Hmm.
From the credit perspective, we are kind of very good credit environment. Like we have witnessed the consolidation of businesses across various sectors, the deleveraging, even in the traditional asset heavy sectors, we have seen like telecom, manufacturing, metal, infra, real estate, or the healthy cash flow generation from the Indian corporates. Uh, they have raised the equity in last 24 to 36 months to deleverage the balance sheet. With the current correction in the commodity prices, we are expecting a margin to improve. All this put together are looking good from the Indian corporate perspective. If you take a view on the BFSI, which is the largest borrower in India in the capital market, debt capital market, uh, our NBFC asset quality has tested the COVID stress. They are into a improving trajectory.
Hmm.
Bank has realigned their portfolio towards the more granular assets and retail assets. Bank balance sheets have improved and they have recognized large part of asset and the asset uh, uh, handover is behind us. The IBC has added the asset change from incompetent management to a competent management.
Hmm.
The initiative from the government, like PLI, are showing the green shoots for
Hmm.
renewed capex from both the public and the private sector. So, in a nutshell, both the macro and the credit environments are very conducive for Indian economy. So my view is that we are in kind of the Goldilocks situation as far as the Indian economy is concerned, but we have to be very watchful of the global macro development in the global market. So we will be very conservative or watchful of a companies who are in the export sectors, who have a very high unhedged commodity risk exposure, and so on and so forth.
Hmm.
Said so, we, if you ask me, after a long time, we are seeing global domestic growth coming back, and the balance sheet is supportive of that. So in a nutshell, the environment is very conducive for Indian economy at large.
Okay. So, Sushil, despite good performance of credit risk funds in the past, many MFDs and investors shy away from this category due to series of credit events in the past. So, what's your message to them?
So, investor has stayed away from the credit products for a various reason in past. But if you see in last 24 to 36 months,
Hmm.
lot of initiatives were taken from by regulators
Yes.
in form of LRM framework, which is
Hmm.
risk management framework, which has been introduced. Various rating based exposure limits, etc., has been introduced by the regulator to ensure that the investors get the stability of the return and the quality of asset is maintained.
Hmm.
So my message to the distributor is that given the backdrop of the good balance sheet, good macro expected over the next 24 to 36 months, we are in a situation where we should, or the investors should, look the kite product and kite risk fund in particular very seriously.
Okay. So, Sushil, one school of thought believes that investors should take risk in equity funds instead of taking risk in credit risk fund. So, what's your comment?
So basically, investment decisions should be guided by the asset allocation of the individual requirement. It is nothing that one asset class is better than the other asset class.
Hmm.
Both have a different role to play.
Hmm.
Both equity and debt, credit risk fund in particular has a different asset class.
Hmm.
You can't compare both. Credit risk fund are designed to give better risk adjusted return to the investor over the medium term of 2 to 3 years or so and so forth. Whereas your equity funds have a very different return allocation expected from the equity fund. So both are very different asset class, and depending on the requirement of the investor, both should have the allocation towards the one's portfolio.
Okay. So, Sushil, talking about the fund, Nippon India Credit Risk Fund has outperformed other funds over the last 1 and 3 year period. So, what has contributed to this performance?
Yeah, thank you very much for the compliment. So Nippon India Credit Risk Fund is been steadily generating the accrual to the investors. This has been guided by a superior risk adjusted return philosophy which we are following. So I just take a minute to explain what is the philosophy of this fund. So like any other fund in the Nippon India Mutual Fund, we have also done the fund casing for Nippon India Credit Fund. That means we have limited the exposure we can take in this fund. Some amount of liquid assets should be there to ensure that any redemption pressure should be handled eminently and without impacting the returns, and so on and so forth. So our broad strategy and the sub classification of assets is twofold. One, we should have enough high quality liquid asset to ensure enough liquidity is maintained to take care of any redemption pressure. And second, we should have the steady state assets to generate a steady state return accrual to the product. So currently we have a 35-65 allocation towards the high quality and 65 towards the steady state accrual product. So given the fund casing and the strategy to manage the risk in much better way to ensure the better and the superior risk adjusted return to the investor have resulted into a outperformance of Nippon India Credit Fund over the last couple of years.
Sushil, there are many companies which fall under credit risk universe. So how do you shortlist these instruments and how do you mitigate risk considering the category is very risky?
So you have to put the risk in a right perspective. So risk, you can't eliminate risk. You have to manage the risk, and how much risk you can manage, you ensure that you take that amount of risk only. So first of all our investments are done according to predefined fund casing, meaning we should have the lower concentration, smaller exposure to the individuals, and that result into a large number of issuers. So we are diversifying our asset base to ensure the we don't run any high concentration risk in the fund. Second, the investment decisions are guided by a rigorous credit underwriting process, which include regular monitoring of the performance of the individual assets. We have a large credit analyst team who is doing the credit risk analysis of individual asset on a ongoing basis. Or to supplement that, we also have the in-house legal team to assist in legal documentation and structuring of the any product. As a fund house, we are focusing more on the issuer operating cash flow to ensure that the periodic cash flows are used to pay back the debt of the company. We have incorporated many early warning triggers within our structures so that any warning can be evaluated and can be acted upon on a timely manner.
Sushil, despite being a credit risk fund, the fund has a healthy exposure to AAA and sovereign bonds. So what's the rationale behind this?
So as I explained earlier, there is a change in the regulatory framework. So liquidity risk management framework, which has been introduced by the SEBI, mandate the fund to have the high quality assets, which include GSEC, sovereign, quasi sovereign, PSU, AAA assets, uh, in line with the dynamics of asset liability of that fund. So to ensure that any untoward stress scenario, the fund is capable of liquidating the assets without hurting the return of the existing investor. So this is the framework which is introduced by the regulator. Further, on top of it, our fund casing requirement also needs some buffer over and above LRM framework to ensure that no untoward or unpleasant experience would be experienced by the investor. So to ensure that investor get the stable return over the period of his investment horizon, there is a comparatively little higher exposures to sovereign and AAA high quality assets in our portfolio. This is to give a better, steady return to the investors.
Okay. One last question, Sushil. Why should MFDs look at recommending Nippon India Credit Risk Fund to their clients?
So any product which suits the requirement of the investor should be recommended. So it is very important to match the requirement with the right product. So if distributor uh, come across any investor who has a moderate risk appetite and medium term view on the investment horizon, should definitely look the credit risk fund and Nippon India credit risk fund in particular. The strategy of the fund is to give the stable risk adjusted return to the investor. We in a fund don't run very high duration, which may hit us from the MTM perspective. The credit exposures which has been taken are self amortizing during the tenure of the NCDs. The idea is to ensure and ring fence the cash flow of the issuer to ensure it is being paid back to service the debt of the company. These are the factors which are key or key for any credit products. And we run it very simply, well-defined fund casing, well-defined strategy, well-defined liquidity metrics, well-defined credit risk metrics are the few of the reasons MFDs should recommend Nippon India Credit Fund to their clients.
So with that, we have come to an end to this interesting session. Thank you so much, Sushil, for your valuable time and inputs.
Thank you, Nissan.
And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.